Welcome back to QAV America. Tony, for new listeners to Australians, value investors. Been talking about value investing on a podcast for years in Australia. Now we're doing an American version where we talk about the North American market. And we can't start talking about the North American market, Tony, without talking about Donald Trump and tariffs and SCOTUS and all that kind of stuff this week. So, as we were talking a little bit about it on our Australian show that we just finished, but as everyone knows, the Supreme Court overturned Trump's tariffs that he had implemented a year or so ago under the International Emergency Economic Powers Act, which the Supreme Court said, nah, you can't do that. That doesn't work. The company that took it all the way up to the Supreme Court was Learning Resources, Inc., a relatively small family-owned maker of educational toys that said it was going to increase their tariff costs 44 times and that there was no way they could survive and afford to cover that. They didn't have the capital to front-run the tariffs. They couldn't relocate their manufacturing quickly like bigger companies might have been able to. And Trump called them dirty sleazebags, or just sleazebags, and unpatriotic sleazebags. How dare you tell me that the illegal thing that I did was illegal? You're sleazebags.
And then
Major
prove it in court.
sleazebags.
Yeah, because you're making educational toys for kids.
Yes, and as I said in the last show,
Obvious Trump for sleazebag.
when somebody who's been found guilty of sexual assault calls you a sleazebag, a major sleazebag, you know, well, you've got problems. You need to take a long, hard look in the mirror, sir. Anyway, so what that means, how they're going to pay back the $260 billion in tariffs that they collected in 2025 remains to be seen. No one knows what it means. He's immediately hit every country in the world with a 15% global tariff. No one knows what that means. No one knows what's going on. It's just completely bonkers. Completely bonkers. But, you know, you and I were talking at the end of the Australian show about what AI is going to do. And you talked a lot on the last show about, which you can talk about again if you want on this show, about the depreciation of capital costs for the Mag 7. Do you want to do your little talk about that again?
Yeah, I think it's important for US investors to have a look at this, but we know from what the Mag 7 companies are doing is they're now investing very heavily in data centers. The graphics chips they need for AI are very expensive, and they have a relatively short shelf life of something like 4 years, I think was the life of a CGU chip. But if you go into the accounting or the balance sheet or profit and loss for these companies, you're not seeing any depreciation charge against the capital investments. And, you know, as any accounting graduate will tell you, is if you invest in capital, you have to depreciate it. So when it runs out, when its life ends, it can be replaced, and that accounting over the years has required that, so that you don't get a lumpy business that looks really profitable for 10 years and then suddenly makes a huge loss because they had to go out and buy a new tractor or whatever. So that's generally accepted accounting principles, exactly what the name says, the GAAP, which should be applied. It's not being applied by the Mag 7 companies. I asked ChatGPT where to go to look for their depreciation, and it said it was unable to pull it out of the various lines in the accounting returns for these companies, but that it was in either R&D or cost of goods or admin expenses or all three, but it was essentially not being called out. So, you know, I'll go on the front foot and say it's being hidden. And I think one of me as a long-term investor thinks that's the case because the Mag 7 companies and companies like them have been classed as capital light. So in their history, they've had very little capital expenditure. They don't have to run outlets of stores or bank branches or farms or manufacturing facilities or whatever. I guess they had manufacturing facilities, but they're capital light compared to a steel maker or a railroad or something that has large capital expenditures and calls out their depreciation. And therefore, they've traded on much higher PEs than traditional manufacturing stocks. And now, if you do dig down and try and work out what depreciation is and what capital expenditure is required, they're not capital light anymore. They're like a railroad. They're like a manufacturer. They're like a US steel company. They're just a run-of-the-mill industrial type company now. And I don't think it'll take long for your average investor to work that out. So at the moment, there's a bit of look at the bright, shiny object of AI here. And there's the CEOs are saying, we're going to be number one. We're going to be the company that, dominates and survives. And it's a race and it's a war, all that kind of stuff. Investors are going to buy that Kool-Aid for a while. Then they're going to start seeing, the depreciation bulging, and they won't be able to hide it for much longer. And they're going to write down the PEs or contract the PE ratios of these companies, and they're going to come down a lot in value. I don't know when that will be, but it's just as logical as value investing in reverse. They're overvalued now. They're not capital light.
Yeah, and a lot of people are calling out the fact that the amount of revenue that these businesses are going to have to generate in order to pay back all of this money that they're raising for building data centers, it's hard to see how that's going to happen. A lot of people are calling it an AI bubble. And the counter argument to that is, well, it's pretty certain that AI is going to be something and somebody's going to make some money out of it, although it also, the counter argument to that is that it can completely collapse socioeconomics as we know it, and everyone loses their jobs, and that creates recessions, depressions that could we could never recover from. The point you and I were making on the show before was that with Trump and the tariffs and with AI bubbles and all of this kind of stuff, no one knows. No one has any idea what the future looks like right now. So all we can do as investors is just keep doing what has worked in the past, which, as far as we're concerned, is buy $1 for 50 cents and just until things change.
And from a company that has that has been making dollars for a long time and looks like it'll keep making dollars for a long time.
Yeah. Until things change. And then when things change, we'll reassess, reevaluate. Yeah. But right now, we just keep doing what we've always been doing, which has worked pretty well so far. Double market returns for as long as anyone's been tracking value investing.
And the only reason I'm calling this out with the Mag 7 and stocks like it is because we rely on accounting. We rely on good accounting. We rely on auditors to check the result on the generally accepted accounting principles, to present the results in the way that we're used to seeing them reliably. And now there's a major cost being hidden. And that to me is just like if I was an auditor of these companies, and I'm sure they've had lawyers look at it and they're found weasel word ways of not listening to pressure.
Yeah. Well, we'll see. Meanwhile, we'll just keep doing what we're doing. Last week on the show, we were talking about Shinhan Financial Group, and that raised the issue of ADRs yet again, American Depository Receipts. And I did do a shout out when I did my Reddit post on Shinhan. I invited people to share their views on ADRs with me. No one replied. So I spent some time in...
You're on the nose in the value investing communities, aren't you, on Reddit?
So I did spend some time in Gemini working through it, and I'm going to try and summarize my understanding of it as quickly as possible. So there's a couple of gotchas here as I understand it. One is that there are called custody fees that the depository bank charges, pass-through fees for servicing the ADR. These are typically about 2 to 5 cents per share annually. So depending on the value of the share, you got to keep that in mind. There's also dividend processing. When SHG, for example, pays a dividend, the depository bank takes a cut, often 1 to 3% of the dividend amount for converting the currency and distributing the funds.
Right.
So you don't get the full value of the dividend. Then you've got the tax issues. This is apparently where most US investors end up taking a bit of a haircut if they didn't plan for it. In the South Korean case with SHG, the statutory withholding tax on dividends for non-residents is 22%, which includes a 2% local inhabitant tax. Then you've got the US-Korea tax treaty. Under the current treaty, US residents can typically have this reduced to 15%. However, you have to get your broker to apply the treaty rate at the source, which is apparently notoriously difficult for retail investors.
Mm-hmm.
You can usually claim a foreign tax credit on your US tax return using something called a Form 1116, but this only offsets your US tax liability. So if you hold SHG in an IRA or a 401k, you might not be able to reclaim the 15 to 22% at all because those accounts are tax exempt and aren't recognized as such by Korean tax authorities. So you're missing out on that dividend altogether in that case. Then you've got the currency and exchange issues that I mentioned last week. Even if, say, SHG stock rises by 5%, if the won continues to weaken against the USD, your ADR could be flat when you go to sell it, the overall value of it. So in times of global stress, the USD tends to strengthen, although that hasn't been the case recently, while the won weakens. That can create a double whammy where the local bank stock drops and the currency devalues simultaneously. But again, it's just a level of complexity that you have to factor in. Then you've got the Korea discount that we talked about a lot on the show last week. Then you've got the geopolitical tail risk, particularly in South Korea, which is, I don't know if you know this, but it's very close to North Korea.
Just below it.
And I said close to it, but yeah, below it. And they did a good job when they came up with the names of North and South. Yeah, they thought that through. Barry and Stan did a great job on that one. So there's this constant assessment of risk about the treaty between North and South Korea and what happens there. So, but that's not really anything to do with the ADRs. That's just another geopolitical risk with investing in South Korean companies. So look, there are complications for US investors with ADRs, and I don't know from a QAV perspective how that translates. Does it mean that we should just not look at ADRs in future when we're building a portfolio? Should we factor them out because of this additional level of complexity? Or, Korea Electric Power has done quite well. It's up, I think, about 30% since we last talked about it. Hold on, let me pull up my pulled pork list here. KEP.
Yeah, that's an interesting question, isn't it? Do we give preference to US stocks? And I guess you probably should, because it makes it simpler for listeners to invest in them. But on the flip side of it, you're giving up 30% returns over a couple of months. So yeah. Do you want easy money? Do you want easy lower money, or do you want to work a little bit and get big gains?
And I think with AI in your back pocket now to help you navigate the ADR complexities, it shouldn't be that hard. It should be just give me an email to write to my broker. Tell me, what tax forms I need to fill out. Korea Electric Power is up 31% since we did a deep dive on it at the end of November. So a little over 2 months, it's up 31%. I mean, that's pretty good. You don't really want to be turning your nose up at that, right?
No. I don't know, Cam. I haven't got the buy list in front of me, but if we've got US stocks near the top that aren't ADRs, maybe we should do pulled porks on those first, and then if we don't, we can go to ADRs after that, perhaps.
Yeah, that's a way of doing it too. Use them as a backup. But then you got Zepp Health Corporation, which I think was an ADR. It's up 665%. So you would have missed out on that.
Oh, think of the tax headaches, though. All that capital gains
the
tax.
tax.
Good problem to have.
Yeah. Well, now that I'm on my list of pulled porks, just a quick summary of how they've done. So these are the deep dives that we've done on the show since March of last year, when we started doing the show on a weekly basis, more or less. I've done 38 stocks. 29 of those are up, 9 are down. So it's about a 76% win ratio. And
Very good.
if I average out, which isn't very scientific, but if I average out the performance of all of those, the average profit is 38%.
Wow.
But a lot of them are up, very, very nicely.
Mm-hmm.
So, and Ford Motor Company, we talked about their losing $8 billion last week. They're still up 26% since we talked about them in May last year. So even with all of that, they're still doing okay.
I think Mr. Ford would have happily written off $8 billion of EVs if he could go back to making F-150 utes again. Or
Yeah, possibly. All right. Well, while I'm here, let's just talk about our portfolio briefly, and then I'll get into my deep dive for the week. So the portfolio we've been running in the US since September 2023 is currently up 103%. Versus the S&P 500 up about 54% over that time. So not quite double market, but very close to double market. And in the last 90 days, it's up 34% versus the S&P up 3.5%. And it's funny, I was on the value investing subreddit the other day, and I saw somebody say, all of my stocks are down over the last 90 days. I don't know. Is anyone making any money? Is anyone's portfolio doing well? Everyone was like, no, mine's down and this is down and everyone's down. I was like, oh, I'm up 35%. I don't know what your problem. And no one said anything. It was like, I expected at least prove it, or what stocks have you got? Show me your portfolio. Nothing. No one said boo. So I like, all right. Yeah, back to my knitting then, I guess.
So listen up, people. There's a 76% chance that this stock that Cam's going to mention is going to be up 38% in 2 months.
Yeah. Well, over a year anyway.
Yeah, okay.
In case people, new listeners, are wondering what the stocks that have done the best in our portfolio over the last couple of years are, I'll read out a quick list of the top ones. Willis Lease Finance up 318%, Innova International up 128%, Euroseas up 118%, BLX, the Foreign Trade Bank of Latin America, up 100%, Tharkos Energy Navigation up 81%, Stealth Gas up 62%, and there's a few more. But no Mag 7s, no tech stocks, nothing like that. All just mostly boring shipping and banks. Finance, literally like Willis Lease Finance, Foreign Trade Bank, Regional Management, Jackson Financial, and UBS. And I think Renaissance Holdings is also real estate or finance investment as well. And then a couple of shipping companies, Euroseas, Sarkos Energy, Stealth Gas, KT, I think. Are they shipping? Can't remember even what they do. Oh, no, another Korean-based company. Korea Telecom. Is that what they are? Korea Telecom. They're up 55% since we had them. When did I add Korea Telecom? September 2004. So there you go. Another one.
Well, you know what? If people aren't buying these ADRs and they're all going up, we should set up a middleman operation. We'll go and buy all the ADRs.
Handle the tax.
Handle the currency exchange and all the rest, and we'll sell them, but we'll make a margin. We'll just use an American company that people don't have to worry about the complications for, and we'll just, do all the admin, and then we'll pass on, maybe a 10% gain when they're up 30. That sounds right, doesn't it?
Yeah.
Basically, reverse tariff. 15, like it 15%.
All right, so let me get on to my stock of the week. Now, complication with this one, as I mentioned to you on our last show, when I looked at this over the weekend, it was a buy. When I went to add it to our light portfolio this morning, it had become a Josephine, which for new listeners means that the share price today is lower than it was at the end of last month, which means we won't buy it because if it's slipping backwards, we want to hold on and A, see why, and B, maybe we can buy it cheaper tomorrow than we can today. So let's see how far it's going to slide. So I'm not going to add that to the light portfolio this week unless it turns around by the time I check it again tomorrow. I'll have to add something else, but I'm going to talk about it anyway because I've done my research on it and it is up pretty high on our buy list this week. The company is called Bread Financial, and slightly disappointingly, A, they don't make bread, and B, there's no murders. There's no death by misadventure. Like out of all of the stories that we've done in recent weeks, this is kind of a boring one, Tony. Like no one got
Well, not
killed
for
in the
me.
making of this story.
Not for me, because when I started doing research on it, I was very happy to see the link with Air Miles, which I came very close to being a manager for the Air Miles company.
Oh, really?
Yeah, I was when I back to when was it? I don't know when it was, late 90s. I was headhunted and flown over to Amsterdam for the weekend, a long weekend. It was Australia Day weekend. I flew out on a Friday night and flew back on a Monday.
Wow.
Yeah, met the head of Air Miles, the chair of Air Miles, who was in London, and went across and spent the weekend in Amsterdam with the company over there. The company, I think, started in Canada, but then it either moved or it merged with something in the Netherlands as well. It was all called Air Miles. Yeah, and I came. So what happened was I had moved from Shell to Colesmire, a big retailer in Australia. But Colesmire were technically under a headcount freeze, so I was put on as a consultant to start off with.
Right.
And I was grumbling, saying, "Guys, you got to, make me full time here, or I'm going to, you're going to lose me." And I came back to work I got back into Australia on the Monday of the long weekend. Jenny said, "I'm pregnant." Go to work the next day. They said, "You're full time." So I had a guaranteed job in Australia, and Jenny was pregnant. So I thought I'll stay in Australia and raise a family rather than, because the job, if I had have taken it in with Air Miles, would have been flying around the world and setting up loyalty companies.
Right.
And in fact, the guy who did take the job was one of my ex-colleagues. He was in New Zealand running the loyalty program over there for Shell. I think he went to spend a couple of years in Israel setting up the loyalty program there and various other places. That would have been a very different lifestyle if I'd done that. Yeah, but know the company well. At least I did back in the 90s anyway.
There you go. I did think of you when I was researching this because I knew you had a background in loyalty programs. Well, so Bread Financial was started in 1996 from the merger of World Financial Network National Bank, which was a credit card bank that spun out of a company called The Limited, and JCPenney's credit card processing unit, basically the back office engine for people that wanted store cards. And it wasn't a founder-led startup. It was sort of a corporate-y, mergery thing, and has had a lot of institutional ownership and continues to have a lot of institutional ownership today. It looks like institutions own roughly 90% of the float, could be even more. Vanguard own 11%, BlackRock own about 10%. There's also an activist holder called Turtle Creek Asset Management that has about a 6 or 7% stake. Although I think they've trimmed their position recently, but got people a little bit interested in the prospects of this business when Turtle Creek started buying in a few years ago. The CEO is a guy called Ralph Andretta, formerly Citibank. He's been running it since 2020, and he's kind of spent the last few years amputating a lot of the non-core loyalty businesses to focus purely on credit cards. So BFH, and I'll talk about why they're called Bread in a moment, but they're basically the invisible store card. We're very familiar with those things here. We've had a number of businesses like that.
Yeah.
in Australia, but
Hum
basic
Financial. Yep.
exactly.
Latitude Financial, yeah.
If you go to a specialty retailer like Victoria's Secret, speaking of Les Wexner's deposition, um, and they offer you a loyalty card, get 10% off if you get the card, etc., etc. In the United States, Bread is often the
hmm
company that's providing that card. They're basically providing you with a loan for credit to
hmm
buy stuff from the shop. And most of their money now comes from two big buckets: the loan book, interest and fees on private label and co brand cards. They also have things like the Bread Cashback Amex. And the savings sides, they also run a direct to consumer digital bank called Bread Savings that gathers deposits and funds those loans directly. But it's a lot of it's subprime or near
Mm.
prime loans, high risk rate for these sorts of things. Probably the first thing that people are going to default on if they
hmm
hit hard times. US economy is either the greatest economy that there's ever been in the history of economies, if you listen to Donald Trump. If you listen to economists, not so good in lots of areas. So
Yeah, and the first thing you're going to return is the Victoria's Secret underwear when you can't afford it, when you hit hard times.
yeah, well, you have to get rid of your mistress first and then take back her lingerie before your wife finds out. Um, Now, there is a thing going on at the moment that's a bit of a Trump slump for credit card companies. Amongst putting in place illegal tariffs and then having them overturned and coming up with new tariffs whose legality are debatable. On January 12th, President Trump called for a 1-year cap of 10% on
Mm.
credit card interest rates starting January 20th. 8 days later, and provided, as usual, no details on how that was all going to work.
hmm
And this is a populist political play. Look, the economy. Everyone's telling him the economy's not doing great. People are struggling. Don't worry about it. I'm going to cut your interest credit card bills down. Spend more. Go out. Spend more. It's okay. I'm going to cap your interest rates on your credit cards. And people are paying 20 to 30% interest rates on credit cards in some cases in the US. And he's basically trying to say he's going to do something about that, but exactly how it's going to work, if it's going to work. January 20th came and went, by the way, and nothing happened.
Yeah. Yep.
So it would be it would save Americans $100 billion a year, I read, if it went ahead or for
You
the
think it would?
year. Yeah.
Wouldn't the credit card companies just charge you to take the card out? Application fees and late fees and all those kinds of things?
Well, I'm sure Trump has thought all that through in great detail, Tony, to make sure that there are no get out of jail free cards
Mm.
here in place. Um, JD Vance apparently has a history of supporting the Credit Card Competition Act, the CCCA, from his time in the Senate. This bill targets interchange fees or swipe fees, as they're
hmm
known, charged by Visa or MasterCard. And some analysts believe that this 10% interest cap is a maximalist opening move on behalf of the Trump administration to threaten the crown jewel of the banks and get them to come
Mm.
to the table to discuss playing along with the CCCA. And it sort of signals a move away from the Republican Party's traditional pro bank policies. But whether or not it actually anything happens or not, a bit like Trump was going to reduce pharmaceutical costs as well, I think, and ended
Right.
up just saying you could get Trump drugs. And apparently, the White House have been floating the idea of Trump cards. You can get your own Trump credit
Of
card with a
course.
10% interest rate. Um, anyway, that is it. I mean, it sounds like a joke thing, but again, if you're a credit card company or an investor in a credit card company, you have no idea about
Yeah.
is this real? Is this just talk? Is anything going to happen? If something happens, this is going to wipe hundreds of billions of dollars off of credit card companies' valuations, or nothing could happen. I mean, so who the hell knows?
And hence, a company like this turns up on our value investing buy list.
Could have something to do with it, yeah.
Mm.
But as of this point in time, we're recording this on February the 24th, so a month and a bit has passed since the deadline. No credit card interest rates have changed. They're still hovering. APRs are hovering between 22 and 24% on average. Legal experts and banking groups say the president lacks the authority to cap rates via executive order. A federal law is required to override existing state-level parity in national banking rules.
Mm-hmm.
And we know that if President Trump cares about anything, Tony, it's very, very
rules.
strict, obeying the laws, sticking to it, like crossing T's and dotting I's. That's what he's really good at.
Getting proper legal advice.
Yeah, not doing anything that could provide any blowback or cause embarrassment or complexity down the track. Yeah. So, seeing as no banks actually did anything, the White House started talking about Trump cards. There is one company called Bilt Rewards, BILT, a fintech, that announced it would roll out a new card that meets the 10% cap for 1 year. Bank of America and Citigroup have apparently spread rumors that they might offer a specific card that'd have a 10% cap, but hasn't happened yet. So just want to flag that all of that is one of the risks for companies like Bread Financial. Something might happen, might not happen, no one knows. Now, there is a little bit of a stink around BFH. There's a company called Loyalty Ventures. They spun off their Air Miles loyalty business, as you indicated earlier on. You're familiar with that. In 2021, not long after they spun it off, it spiraled into bankruptcy. This led to a class action lawsuit alleging BFH, or Alliance Data as they were known at the time, had misled investors about the health of the loyalty business before dumping it. They were previously known as Alliance Data Systems, ADS, and they had this strategic transformation. They started to sell off some of their non-core businesses. Air Miles was one of those. And they sold it off, and as I said, it quickly collapsed. ADS required the newly formed company, Loyalty Ventures, who bought it, to pay it a $750 million dividend as part of the split, which Loyalty funded by taking on a massive amount of debt. And then shortly after the spin-off, Loyalty Ventures' main customer, Sobeys, Sobeys, exited the Air Miles program, and the whole thing sort of plummeted. Sobeys is a national supermarket chain in Canada. I'm sure you're familiar with, seeing as you lived in Canada for quite a few years. And 18 months later, Loyalty Ventures went into bankruptcy. So there's class action lawsuits. What did ADS know? What didn't they tell the market? Did they make false and misleading statements about the health and loyalty of the business, et cetera, et cetera?
Yep.
By the way, they also sold off their data marketing arm, Epsilon, for $4.4 billion. And they also started having rising losses after COVID. Credit card during the peak in 2021 of sort of COVID, credit card companies were making the most out of artificially low interest rates due to government stimulus and COVID packages. And as the economy started to normalize, losses started to go up. So BFH has started to suffer from that. By the way, the BFH thing I didn't mention, they bought a a BNPL company, buy
Yep.
now, pay later.
Mm-hmm.
Afterpay is the one that Australians will
Mm-hmm.
remember that also got bought.
And Klarna is another one that Americans might know of.
Yeah. So they bought one of those. It was Bread Financial. Then they rebranded to sort of get away from the stink of the Loyalty Ventures scandal and
Hmm.
a few of those things, get away from the ADS thing.
Just going back to the loyalty programs, that I noticed that, well, what you were saying about interchange fees is very germane to whether loyalty programs are profitable, because credit card companies and banks will be able to pay for loyalty points out of a high interchange fee on the credit card.
Oh, right.
And I I think from memory, there was government regulation in Canada a couple of years ago to regulate and reduce the interchange fees for credit cards. So that
Right.
may have had a big impact on that business.
Right.
Hmm.
So they probably don't want this CCCA to pass.
Hmm. Well, it's also possible they saw it coming and decided to offload the risk of the loyalty companies into a separate vehicle,
Yeah, right.
among other reasons, perhaps.
So to rebrand as Bread Financial, they had to spend heavily on modernising their legacy systems. They invested over $100 million annually over the last few years into digital innovation and credit card processing transitions. So they've sort of gotten rid of all of these legacy businesses and they're just a pure credit card back end system now, but they've had to spend a lot of money to do that. But they're finally clean and the business seems to be doing quite well, actually, despite all of that. Um, they have a market cap of around $3.35 billion, about 3.6 billion cash in the bank. But we know that looking at cash flow for financial companies is always a bit tricky, a bit
Mm-hmm.
different to your normal business. We don't let that stop us, but it's a little bit tricky than the normal looking at a manufacturing business or a retailing business or something like that. But the stub of the business that's left is doing quite well and seems to be quite profitable. They're generating roughly 19% net margins when the economy isn't tanking. And they've got quite a good dividend that they're paying. They've got a 92-cent dividend that's due to go ex in a couple of days, 27th of February. What is it now? 24th in a few days. The analyst forecasts for the stock are running around about $82, $83, which is about 9 or 10% above where it currently is. So analysts on general seem to think it's going to go up. So it looks like a bit of a, I wouldn't say a cigar butt, but a company that
Mm-hmm.
has gotten rid of a lot of its non-core businesses, kept the one that seems to be making money at the moment. But with all of the changes going on in the US economy, don't really know what the future holds, but that's a good thing that we don't try and predict the future, so we don't have to
Mm-hmm.
worry about that so much. But some of those future things, while I'm on it, just to give people a perspective, the economic forecasts for the US unemployment rate rising from 4.5 to 4.6% this year, which sounds low by historical standards, but credit card processing companies are extremely sensitive to any increase
Mm-hmm.
in unemployment rates, particularly the sort of low hire, low fire labour market over the last 2 or 3 years might cool off. We also know that there's this big hiring freeze going on, according to Jerome Powell in the US, where companies are starting to not hire people because of the expectations that AI is going to do a lot of those jobs that university graduates would be doing in the next couple of years. So, how that plays out and what that means to the unemployment rate in the US remains to be seen. There are anticipated Federal Reserve cuts this year in the US with the change of the chairman of the Fed. Trump's trying to get rid of Jay Powell and replace him with Kevin Warsh. I think that's his name, Warsh.
Mm-hmm.
So that, interest rate cuts are going to have an impact on credit card companies and their margins and their rates. Could mean that their profits go down. We know that when you said on the show last week that when interest rates go up, banks tend to make more money because
Correct.
they just squeeze their margins a little bit, push them up a little bit more. It's the opposite of squeeze,
Well, if you
inflate
keep
their margins.
the same percentage margin, yeah, the dollar value goes up because if you're borrowing bonds to lend to customers at a higher rate, yeah, the dollar amount goes up even though the percentage may stay the same in the margin between what you're borrowing at and what you're lending to customers at.
Hmm.
And if it goes down, the reverse happens. You maintain your margin percentage, but your dollars go down.
But you add to that the fact that consumer sentiment in the US is at the lowest it's been since 1978. Actually, lower than 96% of months since 1978.
Right.
So
What happened in
consumers,
78? Just trying to think. Who was in power then?
Jimmy Carter.
No, wasn't he out in 75?
No, Gerald Ford was out in
Yeah, I was thinking
75.
Ford. Oh, okay.
Yeah, Jimmy Carter came in. Jimmy Carter was there until Reagan, in between Ford and Reagan. So, again, that could be the canary in the coal mine for where the economy's going. No one really knows. It's all up in the air. If you look at their revenue and their operating profit in Stockopedia over the last few years, 2020, their total, this is, before some of their divestments, obviously, but their total revenue was about 3.8 billion, went up to 4.8 billion in 2023. The estimate for this year is a little bit south of 4 billion, going a little bit over 4 billion next year. So they've sold off a bunch of businesses, but if you look at their operating profit, it's gone all over the place as well. It was as high as over $1 billion in 2021, but it was 381 million in 2024, 615 million in 2025. Don't have an estimate here for 2026. But their net profit went up from 277 to 518 last year. It's determined to be about 431 this year. Earnings per share has gone from $4.3 in 2020 up to $10.90 in 2025. Operating margin is running at about 13.7%, not the highest or the lowest, but it's strong. Basically, they look like a fairly strong business that's doing well, making money. But when you look at their QAV numbers, it's very cheap. And again, I know that they're a financial services company and it's a little bit different from looking at some other kinds of businesses, but their price to operating cash flow is 1.56, which is really cheap. On Stockopedia, I could score them for a quality rank. Their quality rank is 60. We score them for that. Their stock rank was above 90 and their F score was above 4.5, so they scored for all of those. Their price was above our intrinsic value number 1, but below our intrinsic value number 2, so I got a point for that. Their price is less than their book price, and it's also, of course, less than book plus 30, so they got points for that. They do have a new 3-point upturn, so I scored them for that. Book value growth is positive, so I scored them for that. Their prop CAF is obviously less than 7, and they've got a positive uptrend. So all in all, when I scored them, Tony, they got a 11 out of 14, or a 79% quality score in the QAV system, and a QAV score, a final QAV score of 0.5, which is
good.
very high.
Yeah,
so a lot less controversial than a lot of the companies that I've talked about in recent weeks, but, kind of a pretty boring credit card company. The future for these sorts of businesses, as I said, in the US is a little bit tricky, but then the future of everything in the US is a little bit tricky to forecast right now. So we don't forecast, we just look at the numbers.
Correct. Yeah, I mean, I thought it was interesting that that these kinds of companies are coming up in our buy list in the US and in our buy list in Australia. We've had 2 or 3 of these on our buy list in Australia. The white label providers of store cards. Um, yeah, so that says to me there's an interesting business characteristic for these companies that people just don't value, whether it's their growth profile or whether it's the risk on the loan book. I'm not sure, but
Interest
and I
rate
did.
fluctuations and
Well, I
all
was
that
going to
kind
say
of
I did
stuff.
see some analysis to say it was interest rate fluctuation um, and consumer sentiment. That because, as you said
Mm.
before, that these cards are the ones that get cut up first, and then they have to get the debt has to be recovered somehow. But when I actually was involved in issuing some of these credit cards when I worked in retail, and at 22% credit rates, and even if you get the numbers we usually crunch at about a 4% loss ratio, even if you get that, you still got a huge margin. Um, but if everyone pays on time, if the rest of the base pays on time, and
Mm.
you collect your fees and everything else, you can have a lot of people not paying you back before it starts to be a problem. So
Yeah.
it's built into that high credit,
The
that high
default
interest
rate is
charge.
built in. Yeah.
Yeah, yeah. So I think people have been trained in the past to sort of trigger a sell when they see unemployment start to rise or when they see interest rates start to rise or whatever, with these kinds of companies. But, just like Warren Buffett said, when there's blood on the streets, that's when you want to be buying these stocks. So I think those assumptions about this kind of company are overdone, and it looks pretty good from the numbers point of view to me.
Yeah, and as I said before, our portfolio is already full of financial
Mm,
services companies.
mm,
They've been turning up on my American buy list for the last 2 years, and we've just bought them, and
hmm
we've done very well out of them. Willis Lease Finance Company in particular. So, yeah, it's my job is not to question what the buy list tells me is good value. It's just to shut up and buy it. Oh, that's a
Or
good
to do
slogan. Shut up and
yeah,
buy.
shut up and buy it.
Yeah.
Or put out a credit card just called shut up and buy it. Um, The interesting thing about this company, which I thought was a bit different to the ones we see in Australia, is it also has a banking license, and I don't know if there's a different regulatory environment in the US compared to Australia, but a lot of companies in Australia have been put off taking out a banking license because of all the extra regulation it brings.
Right.
Because you've got to safeguard people's deposit, you've got to hold extra capital, you've got all the it's a different regulator. There's lots of extra regulation. Um, and and of course it's if you're issuing credit through a credit card, it's kind of a digital situation. But if you're taking money off people, you've got to have a whole heap of um, different types of money operation processes and checks and balances and controls too going on. Um, in Australia, there's a lot of anti-money laundering overhead and regulation, which is probably the same in the US. So I was just surprised to see that this sort of credit card company had taken on the extra overhead of being a bank as well and all that, everything it entails. It does provide you with a cheap source of financing, so I can take deposits and then, back to back the issue of credit cards to customers and finance it and it itself without having to go into the bond market or whatever. But yeah, it does come with overheads.
Mm. Well, just to finalize on that, I'm not adding them to our portfolio because they're currently Josephine, but we'll keep an eye on it. And if it turns around, they might end up in our portfolio. But I'll have to pick something else out of our buy list this week. And just for new listeners, if you don't know how QAV works, we have a couple of membership services. We have a thing called QAV Lite, where we will add stocks and sell stocks from a portfolio based on the QAV system that Tony's developed over the last 25, 30 years. And if you're a QAV Lite member, we'll tell you what we're buying and what we're selling, and you can play along. And then we also have a thing called QAV Club, where we actually give you the full buy list that we produce each week and teach you how to build your own buy list based on the system that in the US has more like 100 stocks on it each week that you can go through and choose from based on any particular requirements you may have from your investing philosophy. But we basically score all of these companies against a whole bunch of financial metrics and then decide what's a buy and what's not. And you can run your own portfolio from that. So go to our website, qavamerica.com, if you want to learn more about how QAV's member services work. Otherwise, just listen to the podcast and we'll tell you what we're doing each week. So that is bread, Tony. The bread of life.
Strange name. I mean, is it like a 70s? Was there like a 70s CEO and you just, said, "Give me the bread. I'm going to use some bread.
Yeah.
Spread the bread, brother."
Probably. It's probably all of it. It's a bread money thing, I imagine. All right. Thank you, Tony.
Okay.
Have a good week.
Thank you.